Hello, welcome to today's Economic Insights. I'm your host, Ruben Tech, and we're going to be diving deep into some complex but crucial topics that are shaping our global economy. Basically, we're going to be talking about the U.S. tariffs and China's massive holding of U.S. debt. Now, the rumor was that Trump really stopped his tariffs, not because people were getting the heebie-jeebies and being panicans, but because China started selling, I think it was $50 billion worth of U.S. bonds. And it turned out that Europe wasn't buying the new bonds that we were issuing. And as you may or may not know, this is a huge problem because it forces the 10-year bond rate to go up. And if you don't know something, it's that means that our government has to pay more to get people to buy our bonds, which is not a good thing because it makes the interest payment higher. And they use this debt to finance their activities. So if people aren't going to buy it at all, they have a problem if they're struggling to find buyers. And so Besant, I always forget how to say his name. He really didn't like this. If you didn't know his first stint in Washington, his entire basically goal was to lower the 10-year Treasury to as low of a possible of a rate. Of course, he didn't achieve that, but you can imagine that the rate going up like this, the pressure that he felt on the bond market, on the debt market, was not a good thing. Now, I know this sounds complicated, but let's understand that the interplay here is key to making sense of all this trade wars, inflation, and economic pressure that we all feel right now. We're going to break down a detailed analysis to understand what's really going on. So picture the global economy as like a vast interconnected network. For decades, this network has been largely built on the idea of comparative advantages. Basically, countries are specializing in what they produce most efficiently and trading with each other. Think about your smartphone. The components might come from several countries assembled in another, all based on cost and efficiency. This globalization has created complex supply chains and deep economic interdependence. It brings benefits like lower prices and more choices, but also vulnerabilities. Disruptions in one place can ripple outwards very quickly. Now we're going to enter the two big players in our story today, the United States and China. Their relationship is complex, marked by both cooperation and intense strategic competition. The two key areas highlight this tension. China's role as a major buyer of U.S. government debt. They're one of the largest buyers of our government debt, specifically U.S. Treasuries, and the U.S. recent assertive use of tariffs, which are essentially taxes on imported goods. Now let's go ahead and tackle China's Treasury holdings first. You often hear headlines about China holding huge amounts of U.S. debt. As of early 2025, the official figure was around $760 billion. So that's down from a peak over $1.3 trillion back in 2013. They've been selling this over the last 4 to 8 years. They've increased the rate. There's speculation that this gives China a powerful weapon. Could they just dump these bonds and crash the U.S. economy? Well, the analysis suggests this treasury weapon idea is largely overblown. Okay, so even though yesterday we heard that they might have dumped like a sizable amount, they could never dump the entire thing. So why does China hold so much U.S. debt in the first place? Is what we have to ask ourselves. Well, it's mostly a consequence of its economic model. China exports a lot, earning U.S. dollars in return, and to keep its own currency, the renminbi, from getting too strong, which would make its exports more expensive, China's central bank buys up those dollars and invests them in U.S. Treasuries. And U.S. Treasuries have historically been seen as the safest, most easily traded place to park all these vast reserves. Okay, for a while, I think we've had AAA forever. Only for a while, it was like AA, I think. Or maybe it was AAA plus and then we were AAA minus for a while. I forget what it is, how they rate, the security of these things. But basically, U.S. Treasuries are a top rated place, safest investment you can make as rated by whoever rates these things. So these holdings are more a result of global trade imbalances and China's currency strategy than deliberately acquired point to leverage. Could they sell? Yes, and data shows a gradual reduction in diversification, notably into gold, which they have been buying by crazy amounts over the past couple of years. Perhaps a long-term move to reduce reliance on the U.S. dollar system and geopolitical tensions. But could they sell aggressively to hurt the U.S.? This report argues probably not effectively, okay? Though we found out yesterday, it sounds like they sold a larger amount. Self-inflicted harm. Dumping treasuries would crash their price, massively devaluing China's own remaining holdings. So you dump 50 billion onto the market, that's one thing, but you dump 500 billion onto the market, that's another. Okay. And so that could devalue China's own remaining holdings, its own debt that it holds. And if you dump something like that, you might not find buyers, okay, which would greatly devalue it. But also likely strengthen their currency, hurting their crucial export sector. Lack of alternatives. Where else could China put hundreds of billions of dollars with the same safety and liquidity? Few markets can absorb that kind of cash. Even gold couldn't just absorb. They couldn't go out and just immediately buy hundreds of billions of dollars of gold that easily. The U.S. Treasury market is absolutely enormous. While a huge sell-off would cause disruption and likely raise U.S. interest rates somewhat, other investors, domestic and foreign, would likely step in to buy cheaper bonds. The U.S. Federal Reserve also has tools to stabilize markets. Data opacity. It's worth noting that tracking exactly how much U.S. debt China holds is tricky due to assets held through offshore accounts, which adds uncertainty. The bottom line, while China is gradually diversifying itself, using its treasury holdings as a short-term economic weapon, carries huge risk for China itself, making this scenario very unlikely. Okay, so what was the scenario again? The idea that they're going to go ahead and wage economic warfare by dumping all these bonds at once. I could see them saying, hey, we're going to punish you a little bit by doing sell-offs like they did the other day. But I don't think that the fact that they're going to just kind of come in and try to crash our market, because that would hurt them just as bad. Remember, this is of value to them too. They're parking all their reserves in this. So if it gets devalued, if it devalues for us, it's also going to devalue for them. I hope that makes sense. Now let's switch gears to U.S. tariff policy. Started significantly in 2018 and continuing with escalations in 2025, the U.S. implemented broad tariffs on goods from many countries, especially China, but also impacting allies. Tariffs were imposed on steel, aluminum, and eventually vast swaths of imports, which recent proposals even suggested universal tariffs on rates hitting 100% or more on specific strategic goods from China like EVs and semiconductors. Just the other day, China has now a 125% tariff on everything. So what are the stated goals of this? Well, protecting U.S. industry and jobs, national security, fighting unfair trade practice like intellectual property theft, which is rampant in China. If you work with China, you absolutely know they'll steal your IP and turn around and sell your product on a side market, reducing the trade deficit and gaining negotiating leverage. But what have the actual economic impacts been? Well, according to the research that I put together here in this report, the findings are pretty stark. Overall, evidence shows the cost of tariffs are obviously passed on almost entirely to American importers, businesses, and ultimately consumers through higher prices. The idea that foreign companies pay the tariffs don't hold up in reality. As I've told you on this channel, I worked in a business that imported items under the first Trump tariffs. We got hit by it, and we had to raise the price of Costco. The consumer had to pay for it. We didn't pay for it. The consumer did. I mean, we paid for it at the port, but then the consumer had to pay us for it. So it raised the price of this item, and thankfully it hit our competitors too, so they had to raise theirs too. But unfortunately for the consumer, an item that they got for, let's say $100, they now had to pay $125 for. These tariffs acted like a broad tax increase, contributing significantly to inflation, potentially raising the overall U.S. price level by 1 to 2.3%. This translates to an estimated, annual cost equivalent to thousands of dollars per U.S. household and lost purchasing power. Economic growth studies consistently find a negative impact on U.S. GDP growth, estimated at roughly 0.5 to 1.2 percentage points annually. This is driven by higher consumer prices, increasing costs for businesses using imported materials, retaliatory tariffs hurting U.S. exports, and general uncertainty discouraging investment. Jobs and reshoring. While some specific protected industries might see small gains, these are often outweighed by losses elsewhere, like in sectors using tariff inputs or facing retaliation. Critically, there's little evidence of significant reshoring. Instead, many companies shifted supply chains to other countries like Mexico or Vietnam, not back to the U.S. This is true. Look at Apple. They're not going to ever build phones here. We don't have the supply chain set up. So what they're doing right now is they're shipping all their phones out of China that they have made over to India and trying to get as fast as they can into India. They're not coming back to the U.S. They're just going to move over to India. or to Vietnam or to Mexico or somewhere else. They're not coming here. Tariffs proved largely ineffective. I look at TSMC. They built that plant in Arizona and they can't find workers, so they have to bring in workers from Taiwan to work at the plant. And then people are like, "Why aren't you hiring Americans?" They're like, "The Americans aren't skilled enough." Ineffective at reducing overall U.S. trade deficit, which is driven more by macroeconomic factors like national savings and investment. Retaliation, predictably, trading partners hit back with their own tariffs on U.S. goods, hurting American farmers and manufacturers. That's happening right now, of course. So an analysis concludes that these broad tariffs have imposed substantial costs on the U.S. economy itself, likely outweighing any benefits to specific protected sectors. They function mainly as a tax on Americans to disrupt those efficient global supply chains we talked about earlier. So let's bring these two threads together. We see a contrast. China's perceived leverage through Treasury bonds seems limited by self-interest and market realities. Okay, they're not going to be able to sell all these, and if they, even if they could dump them all, whatever they have remaining is going to be less. And what are they going to do with the money? Where are they going to put it? They have to put it somewhere. So they're not going to do that. On the other hand, the U.S. use of broad tariffs seems to inflict significant measurable economic pain domestically while falling short of many stated goals. There's also fundamental tension highlighted. The U.S. pursues aggressive trade actions that can harm global economic ties while simultaneously relying on foreign capital inflows, including from those same trading partners buying Treasury bonds to help finance its government spending and fiscal deficit. Imposing tariffs could potentially make foreign investors less willing to hold U.S. debt over the long term, potentially increasing borrowing costs, which just happened. So I put this report together, but this literally just happened, okay? So we just saw this, right? This is why Trump, the rumor is that he dropped it, because Europe said, we're not going to be buying your bonds in the same amount. And then the government's like, what are we going to do? We have to raise the rates to force people to buy it. Okay. But they don't want to do that because then that increase their debt payment. Okay. So it's like, and what if people stop buying altogether? And they're not going to stop buying altogether. There's always going to be buyers. But what if a large percentage of them, that's how we rely on these other companies to buy our treasury bonds to finance our government and it's our debt, okay? Because our government's always in debt every single year. We're going to spend $1 trillion on the military this year. Okay, we're never going to be out of debt. People think we're going to be out of debt. That's a joke. Trump doesn't care about the debt. The deep interdependence of a global economy means protectionist actions have far-reaching, often unintended consequences. Disrupting optimized supply chains with broad taxes doesn't easily bring jobs back or fix trade imbalances. It tends to raise costs and slow down the economy overall. So what's the takeaway? First, the narrative of China holding a financial kill switch over the U.S. via Treasury bonds appears exaggerated due to powerful constraints. Gradual diversification is absolutely happening, but sudden dump is unlikely. So yes, they are going into gold. They are slowly selling these off, but they're not going to try to collapse our economy because it would collapse their own economy. They have nothing that they can go into with that cash. Okay, so it's going to devalue their own holdings at the same rate. So you could say they could go into gold, but again, you can't buy that much gold. They're not going to buy Bitcoin or something like that. That's just retarded. I've heard some people say that. I shouldn't use that word, but it's okay to use because Elon uses it. Second, recent U.S. tariff policies, despite their stated aims, have come, I do apologize to anybody, I shouldn't have said that word, have come at significant economic costs to American consumers and businesses, contributing to inflation and slower growth with limited success in achieving reshoring or deficit reduction. Third, this highlights the realities of our interconnected global economy. Actions like tariffs have ripple effects that are hard to control and often impose heavy domestic costs. Looking ahead, business face pressure to build more resilient supply chains. Policymakers face the challenge of weighing the real cost of protectionism against its limited benefits, perhaps exploring more targeted tools or international cooperation to address trade issues. Persistent tensions, ongoing reserve diversification by central banks globally, and maybe even a shift towards more regionalized trade blocks are all possibilities on horizons. Understanding these complex dynamics, the limits of financial leverage, the real cost of tariffs, and the nature of global interdependence is crucial for navigating an economic landscape ahead. And that's all for what I got for you today. So again, let's just sum things up. Let's just make it real simple. Okay, so I got all this data for you. What does it mean? Listen, our government is going to war with everybody at the same time, which is just simply, I don't want to use the other word. Let me use another R word, ridiculous. Okay? Because the world buys our debt. Okay? We have this beneficial relationship. Sorry, I got an earache and my tinnitus just started ringing really loud. We have this interdependence where We rely on the world to buy our debt so that we can spend all the money that we spend. Okay. And they look at us and we have the best rated debt in the world. We always pay our bill. So it's like AAA plus, I believe is the rating. Only one time where it went down, when they shut down the government, it went down to like, I think it was AAA minus or maybe it was AA. Okay. So they buy our debt. But if we're going to say to all these people, if we're going to be fighting with all of them at the same time, one, they could start selling debt. Now, they're not going to try to crash our economy because it's going to hurt them because the world holds a lot of our debt. Okay. They are trying to get away from us. I've talked about how they're trying to move out of the SWIFT payment system. Okay. Because they don't want to be facing sanctions. We know that China's, got the digital yuan, but China holds a lot of our debt. Europe holds a lot of our debt. So they're not going to do anything drastic because it would hurt them too. But they can start selling slowly and they can reduce their buying. And what that's going to do is it's going to force our 10-year bond rate, our bond rates to go super high. And if that happens, that's going to put us more and more into debt. I mean, it's going to be an unending spiral of doom. It's not going to end well. So why would we want to do this? Like if you're going to do it one country at a time. Take your time, negotiate with a few countries or with a block of countries, not everybody at once. Okay? So they do have leverage over us, but they don't want to pull economic suicide by going ahead and dumping it all. But at the same time, we shouldn't be pressuring them to even, threaten us with that. I don't think so. And then the second thing is that tariffs absolutely have proven that they are ineffective in every way. The free market has already determined that those jobs are better off overseas. And the free market has set up the supply chains accordingly. Bringing that back to America isn't going to happen. It just isn't. Unless we want to be taxed to death to support these businesses over here, because that's what it would take. Okay? So, that's what I got for you. If you enjoyed this, please hit the like and subscribe button down below. All of you out there, have a great day.